Welcome back to Macro Examiner, your go-to channel for in-depth analysis of economic trends and financial markets. In today's video, we'll be diving into a series of intriguing charts from various investment banks that explore the current state of financial markets and the economy. Let's get started. Our first chart is from the Chicago Board Options Exchange. It shows that 1.8 million call options contracts for the S&P 500 traded in one single day, a new record. The next chart shows this same data point, but extends back to 2003. As you can see, the volume of call options traded in a single day for the S&P 500 is at record levels, which goes to show how much options activity has come to dominate markets, with 0 days to expiration options fueling this. Moving on to another options-related chart, we have Amazon's daily call volume, which has recently seen a spike. Amazon announced a recent partnership in generative artificial intelligence, and Amazon Prime Day is less than 13 days away. Bank of America shows that Amazon shares have risen 13 days, and 5 days before Prime Day going back to 2015. Additionally, JP Morgan says Amazon has 40% plus U.S. e-commerce share and should become the largest U.S. retailer in 2024. JP Morgan reiterated Amazon as their best idea, and the 145 December 2023 price target they have is based on 13.5 times 2024 adjusted earnings before interest, taxes, depreciation, and amortization of $108 billion. Our next image from Goldman Sachs highlights a rebound in global flows to equities, which is at the highest level in 6 months, as investors who were underpositioned have had to buy in at elevated levels, with the S&P up 13% year-to-date, while the Nasdaq 100 is up more than 37%. Continuing with this next image, we can see the stark difference in the flows into technology stocks versus cyclical stocks in commodities, materials, energy, financials, and industrials. Technology stocks have significantly outperformed in 2023, which is reflected in these flows. Moving on, our next chart shows the S&P 500 in black and liquidity proxy in blue. As we can see, the two are positively correlated. When liquidity is being removed, risk assets like stocks tend to decline. When liquidity is rising and abundant, risk assets perform well. Additionally, this next image shows the Bank Term Funding Program rate and the S&P 500. This image highlights the fact that the Fed's shadow liquidity program is propping up risk-taking behavior across markets, which can be seen in the rise in stocks since March of 2023 at the onset of the regional bank crisis. Continuing with our next chart, which shows internet and AI news references as a percentage of total Bloomberg news, going back to 1995 and highlighting the 2000s.com bubble. It shows AI references are rapidly rising, similar to the early 2000s. This AI-driven hype, combined with the liquidity injections from the Fed, has brought equity positioning to clearly overweight, according to Deutsche Bank. Positioning is currently in the 64th percentile. Next, we have a chart from JP Morgan Trade Desk with these comments from them. We calculated an in-house sentiment indicator of squeeze risks in the market. It indicated that squeeze sentiment, relative to history, is at the 99th percentile. This suggests a pause in the squeeze rally. Moving on, we have a chart of the VIX, commonly known as the Fear Index, which currently sits at the bottom 10% of a 5-year range, according to Bespoke Invest. The VIX measures 30-day implied volatility in the S&P 500. This level on the VIX suggests little to no fear in the market. Additionally, these lower levels of volatility have sucked back in volatility control funds, which have poured billions back into the market as the VIX has fallen. Moving on to our next image, we have the S&P 500 index seasonality. The circled area highlights where we currently are and suggests major seasonal strength to begin in late June, early July. Our last chart of the day is from Macro Bond. It shows the leading economic indicators index year-over-year in orange and GDP year-over-year in gray. Leading economic indicators point strongly to a recession in late 2023 or 2024, as the economy has proven to be more resilient to interest rate increases by the Federal Reserve, which has pushed out analysts' estimates of when they expect a recession to occur. That's all for today's video. If you found this analysis helpful, don't forget to like and subscribe to our channel for more macroeconomic insights. As always, we'll continue to keep you informed about the latest developments in the world of finance and economics. Thanks for watching, and we'll see you in the next video.